JPMorgan Chase is not lying. A global financial crisis in 2026 is already on the table, and if you think you'll see it coming, you won't. Because real crises don't happen overnight. You don't go to sleep and wake up to a collapse. Every major financial crisis in history left signals, clear, visible signals, 1 to 2 years in advance. Not hidden, not secret, public, on your phone, on the news, every single day. So here's the real question. If everyone can see the warning signs, why does almost no one act? Why do most people just ignore it and keep living like nothing is about to happen? Are they blind, or do they just believe this time is different? Because by the time it actually hits, it won't just be the market. It'll be your job, your savings, your entire financial life. Let me show you how this really works. Imagine 6 people sitting at a table, playing Russian roulette. 1 bullet, 6 chambers. The first person pulls the trigger, nothing happens. The second, nothing. The third, still nothing. Now it's your turn. And suddenly, it doesn't feel dangerous anymore. You start thinking, maybe it's safe. Maybe there was never a bullet. But here's the reality. If the bullet is still in the gun, the probability of you dying just jumped from 1 in 6 to 1 in 3. And that's exactly how financial crises work. The longer nothing happens, the more dangerous it becomes. Because risk doesn't disappear. It builds silently until one moment it doesn't. And when it finally breaks, to everyone else, it feels sudden. But in reality, the warning signs were right in front of you all along. Let me ask you something. If you lend someone money for 1 day and someone else for 10 years, should the interest be the same? Of course not. Because the longer you lend, the more can go wrong. People lose jobs, businesses fail, life changes. Time creates risk. So in a normal world, the longer the loan, the higher the interest. That's not finance. That's just common sense. That's how banks make money. They borrow short-term and lend long-term and keep the difference. That's the system. But sometimes that system breaks. And when it breaks, it doesn't happen loudly. It happens quietly, in the background, because there are moments when short-term interest rates become higher than long-term rates. Think about that. You're getting paid more to lend money for 1 year than for 10 years. That shouldn't happen. It makes no sense, unless something is already wrong. This is called a yield curve inversion. And this isn't just theory. Every single time this has happened in the U.S., a crisis followed. Not most of the time. Every time. The dot-com crash, 2008, 2020. Different stories, same signal. Now here's where it gets real. Because this doesn't stay on charts, it shows up in your life. Suddenly, loans get harder to get. Mortgages get more expensive. Credit card interest jumps to 20%, even higher. And here's the part almost no one talks about. Some people are now paying more in interest than the actual things they bought. Think about that. They're not paying for the house. They're paying for the cost of money itself. And when that starts happening, the system is already under pressure. Businesses stop borrowing. Then they stop expanding. Then they stop hiring. And eventually, they start cutting jobs. But none of that happens instantly. At first, everything still feels normal. People are still working. Markets are still moving. Nothing looks broken. And that's exactly why it's dangerous. Because by the time you feel it, the process has already been running for months, maybe longer. And right now, that process has already started. The U.S. yield curve was inverted for 27 months, the longest in modern history, and it only ended in 2025. So if this signal has never been wrong, why hasn't anything collapsed yet? Why does everything still feel fine? Maybe this time is different. Or maybe you're standing in the exact same moment people stood in, right before every major crash in history. Because here's the truth. The inversion is not the crash. It's the setup. The system is already under pressure. Money is already tightening. And somewhere, something is starting to break. You just don't see it yet. But you will. So here's the part almost everyone gets wrong. They see the signal, they understand it, and then they ask, if this is real, why hasn't anything crashed yet? And that question is exactly why they lose. Because a yield curve inversion doesn't mean the system collapses immediately. It never does. There is always a delay, a gap, between the warning and the damage. And historically, that gap has already played out over and over again. After the inversion ends, it doesn't crash right away. It takes time, sometimes 9 months, sometimes up to 2 years, not because nothing is happening, but because everything is happening slowly under the surface. The crash is not an event. It's a process, and that process follows a pattern every time. First, the inversion happens. That's the warning. Then, banks start tightening. Quietly, they don't panic, they don't make announcements, they just lend less, approve fewer loans, raise standards. Only the safest borrowers get access to money. And here's the part almost no one notices. Some small businesses that used to get approved for loans in a few days are now waiting weeks, only to get rejected. No explanation, no warning, just no money. And when that starts happening, you're no longer in the warning phase, you're in the process. Then, businesses feel it. At first, it's subtle. They delay expansion. They cut spending. They stop taking risks. Then it gets worse. They can't refinance debt. They can't access new capital. Cash starts running out. And when that happens, they start cutting costs, which means jobs. Layoffs begin. Slow at first, then faster, then everywhere. Consumers lose income. Spending drops. Demand falls. And only then, the economy breaks. Not at the signal, but long after it. Now here's the uncomfortable part. The last inversion ended in 2025. It's now been about a year, which means we are no longer waiting for the process to begin. We are inside it, right in the middle of that 9-month to 2-year window, the most dangerous phase, the phase where everything still looks normal, but the system is already weakening. So now you have 2 choices. Either this time is different, or you're standing in the exact same moment every generation has stood in, right before everything breaks. And just like in that game, 3 people already pulled the trigger. Nothing happened, so the next person thinks it's safe. But in reality, this is exactly the moment where the risk is the highest. Now let's go deeper, because this is where the system actually breaks. It all comes down to one thing: banks. Because banks control the flow of money, and the way they make money is extremely simple. Let me show you. Imagine this. You deposit $1 million in a bank. They pay you 1% interest. Then they take that same money and lend it to someone buying a house for 10, 20, even 30 years at 5% interest. That difference is their profit. That's the business model. Borrow short-term, lend long-term, keep the spread. Simple. Now flip it. What if the system changes and suddenly the bank has to pay you 5%, but can only lend at 4%? Every loan they make loses money. So let me ask you, if you were running that bank, would you keep lending? Of course not. And that's exactly what happens. Not in theory. In reality. Banks don't announce it. They don't panic. They just quietly shut the door. They approve fewer loans. They raise standards. They slow everything down. And then they become extremely selective. Only the biggest companies, only the safest clients, only the people who don't need money can still get it. Everyone else gets pushed out. And here's the part that most people don't realize. Right now, some people are paying over 20% interest just to borrow money. And even at those levels, they're still getting rejected. Think about that. Money has become so tight that even expensive money is hard to get. And when that starts happening, you're no longer in a normal economy. You're in a tightening system because money is no longer flowing. It's being held back. And when money stops moving, everything downstream starts to break. People can't borrow. Businesses can't expand. Old debt can't be rolled over. And that's when pressure builds. Slowly, quietly, but relentlessly. Because businesses don't fail the moment credit tightens. At first, they survive. They cut costs. They delay plans. They try to hold on. But over time, cash runs out. And when that happens, They don't cut small things anymore. They cut people. Jobs disappear. Income drops. Spending falls. And once that chain reaction begins, the system doesn't slow down. It suffocates. And that's why this takes time, because it's not an explosion, it's a squeeze, a slow tightening, until something finally breaks. And when it does, to everyone watching, it feels sudden. But in reality, it was built right here, inside the banking system, quietly, step by step. So now the question is, if this is already happening, how much time do you really have left? Now, let's move to the second signal, because what you've seen so far is how the system breaks. But this is how you detect it. It's called the SOM rule. And despite the name, it's incredibly simple. Here's how it works. When unemployment rises by more than 0.5% from its recent low, a recession has already started. Not might, not could, already. Because unemployment is not a prediction, it's a reaction. By the time people lose jobs, something deeper has already broken. Now here's where it gets interesting. If you look at the data today, everything seems fine. Unemployment is still relatively low. The SOM rule has not been triggered. At least, that's what it looks like. But if you zoom in, you start to see something change. Not a crash, not a spike, just a quiet increase. A slow move upward, small enough that most people ignore it, but consistent enough that it's not random. And right in the middle of that movement, there's a gap, a missing piece in the data, a moment where we don't have a clear picture of what's really happening. Now think about that. If unemployment is starting to rise and continues to rise, what do you think happens inside that gap? Does the trend just stop, or does it continue? And we simply don't see it, because if you fill in that gap, even conservatively, the increase may already cross that 0.5% threshold, which means, by this rule, the recession may have already started. Not in the future, not coming soon, already underway. But here's the part that hits real life. Recessions don't begin with headlines, they begin quietly. At first, you hear about a few layoffs, a company here, another one there. Nothing major, nothing that feels like a crisis. Then a few more, then entire teams. Then entire industries. And by the time it becomes obvious, it's not early anymore. It's already everywhere. And here's the uncomfortable truth. By the time the data confirms a recession, you're not early. You're late. Because the system has already been weakening for months, maybe longer. And here's why this signal matters so much. Because the SOM rule has been one of the most reliable recession indicators in modern history. Every time it triggers, a recession follows, no exceptions. So now you're left with a very uncomfortable question. Are you looking at a stable economy or just an incomplete version of it? Because if this rule has already been triggered, then the timeline changes. You're not waiting anymore. You're already inside it. And by the time everyone else sees it clearly, it won't be a warning. It will be confirmation. And at that point, there's nothing left to predict, only consequences. Now this is where everything becomes real, because up until now, we've been looking at signals, patterns, mechanisms, but this part is behavior. This is what the biggest players in the world are actually doing with real money. And money like that doesn't guess. It moves early. Let's start with JPMorgan Chase, the largest bank in the United States. Not a small player, not a trader, a system-level institution, and recently, they've been making a very unusual move. At one point, they reduced their reserves from over $400 billion to around $60 billion. Think about that. That's not a small adjustment. That's not rebalancing. That's a massive withdrawal of liquidity. The kind of move you don't make unless something is about to change. Because for a bank like that, those reserves are not just cash. They're protection, their flexibility, their survival. And when you start pulling that kind of money out, it's not confidence, it's preparation. It's like pulling emergency fuel out of storage before a storm hits. So where did the money go? It didn't disappear. It moved into long-term U.S. government bonds. And that is where the signal becomes impossible to ignore, because when you buy long-term bonds, you're making a very specific bet that interest rates are going to fall, not slowly, fast. And rates don't fall fast in a strong economy. They only fall fast when something breaks. There is no other scenario. So this isn't just a trade, it's a position, a bet on a future where the system weakens enough to force rates down. Now look at Warren Buffett. Completely different strategy, completely different style. But look at what he's doing. He's not chasing growth. He's not going all in. He's doing the opposite, selling stocks, holding massive amounts of cash, waiting. And that should make you pause, because people don't hold cash for no reason. They hold cash when they expect prices to get better later, much better, which only happens after things break. So now you have two signals. JPMorgan is positioning for falling rates. Buffett is positioning for falling prices. Two completely different moves, but both point to the same direction. Something is coming. And here's the part most people miss. Retail investors look at the market and think everything is fine. Prices are stable. There's no crisis. But smart money doesn't wait for confirmation. It moves before the story becomes obvious. Because by the time everyone agrees that something is wrong, the move is already over, the opportunity is gone. And here's the uncomfortable truth. By the time you see it clearly, it's already too late to position, because the biggest money in the world has already moved, quietly, early, and in different directions, but with the same expectation. The system doesn't hold. So now the question is, if the people with the most information and the most at stake are already preparing, what are you doing? Now, here's the part that almost everyone gets wrong, because when people hear this, they think it's good news. The Federal Reserve starts cutting interest rates, lower rates, cheaper money, more liquidity. On the surface, that sounds like relief, like things are getting better, like the system is being saved, but that's not what's actually happening, because if you look at history, rate cuts don't stop crises. They show up right before them. In 2007, rates were cut. Then 2008 happened. In 2019, rates were cut again. Then the system needed emergency support. So let me ask you, if rate cuts are supposed to fix things, why do they always appear right before everything breaks? Because rate cuts are not a solution. They are a signal, a reaction. They happen when something inside the system is already failing, not obvious, not visible, but real. And here's where you can actually feel it. Right now, borrowing is still expensive. Some people are paying over 20% interest on credit cards. Mortgage rates still above 7%, even after rate cuts. Think about that. If money is getting cheaper, why does it still feel so expensive? Because the system is not being fixed. It's being held together, and you can feel that pressure in real life. You feel it when borrowing gets harder, when approvals take longer, when banks say no more often than yes, when your money just doesn't go as far as it used to. That's not random. That's tightening. That's the paradox. Rates go down, but stress goes up. And that only happens when something deeper is breaking underneath. And by the time the Fed starts cutting aggressively, it's not early. It's already late. Because the system has already entered the most dangerous phase. They're not preventing the fall. They're trying to slow it down. And sometimes they don't even succeed. So when you hear the Fed is cutting rates, you have to ask yourself, what are they seeing that you don't? Because institutions like this don't move randomly. They move when the pressure is already too big to ignore. And here's the part most people miss. By the time the Fed reacts, the system isn't being saved. It's already failing, quietly, under the surface, just like everything else you've seen. So now the question is no longer, is the Fed helping? It's, how far has this already gone, before you even noticed? Now step back for a second. Forget everything else. Just look at what's happening. The yield curve inverted, credit tightened, banks pulled back, unemployment started to move, smart money repositioned. And now, the Federal Reserve is cutting rates. Not because things are strong, but because something isn't. So what does that actually mean? It means we're not really guessing anymore. We're choosing between two versions of the same story. Either this has already started, or it's close enough that the system is trying to stop it. That's it. Nothing else really fits. And if you think about it, both of those lead to the same place. Pressure, instability, things repricing. So even if you give the system the benefit of the doubt, you're still looking at something like a 70, maybe 80% chance that something goes wrong, not because someone predicted it, but because everything is already lining up that way. And here's the part most people don't realize. Risk doesn't feel like risk when it's building. It feels normal. Everything still looks fine. Markets still move. People still go to work. Nothing looks broken. Until suddenly, it does. And by the time everyone agrees that something is wrong, you're not early anymore. You're just aware. Because when it gets to that point, people don't lose money because they didn't know. They lose money because they thought there was still time. So the real question isn't, will there be a crisis? It's, how far has this already gone without you noticing? And when it finally becomes obvious, what's left for you to do about it? So let's simplify everything. Right now, there are only two possibilities. Either the crisis has already started and the Federal Reserve is reacting to it, or it hasn't fully started yet and they're trying to prevent it. But even in that second scenario, there's still a 50% chance they fail, which means overall, there is still at least a 25% chance that a crisis happens anyway. And that's not a small number because even right now, people are paying over 20% interest on their credit cards and still spending like nothing's wrong. That's what this looks like before it breaks. You don't have to believe any of this. But at the end of the day, what matters is simple. Are you making money or not? Because different people are already making different decisions. JPMorgan Chase is moving into long-term bonds. Warren Buffett is selling stocks and holding cash. And for me, I'm positioning into gold and silver. Different strategies, same idea. No one is sitting still. So the only real question is, do you actually have a plan? Or are you still waiting for everything to become obvious?